Hey guys, All in Crypto here, and welcome back everybody for another YouTube video. Today we've got a really interesting video lined up. We're going to be talking about our good friend, the yield curve. The yield curve, or the particular yield curve that we're going to be looking at today, is going to be the 10s and 2s for the US. So this is the 10-year government bond yields for the United States and the 2-year government bond yields for the United States. We're going to talk about the yield curve. I'll explain what it is. This is something that we've been looking at for a long time now. And actually, recently we've came out from the 1st of January and we've said we've now taken a non-bearish approach to looking at the cryptocurrency markets. Whether that will prove to be the right approach or not, we'll find out. But just because we've taken a non-bearish approach doesn't mean that we've necessarily taken a bullish approach. Although I did release a video on a particular altcoin where I spoke about my own positions. The fact that, on the 5th of January, we may have been looking to put some money back into the markets. But that's not really what I don't want to talk about my own positions in this video. I really want to look at the markets, look at the broader financial markets, and try and figure out where the cryptocurrency market is probably heading in the grand scheme of things, or relative to everything going on. And I think a lot of the answers actually lie within this yield curve. Now, this is a tweet from David Bell. I'm sure you guys are familiar with David Bell. We've had him on the show a number of times. Good guy to follow for sort of a macro insight on things. He's actually highlighting the 3-month and the 10-year, which is something that the Federal Reserve particularly pay a lot of attention to. And he's essentially saying something that is similar to what we've been saying over the past couple of months, and that is a recession or a crash that the yield curve predicts is not a word, usually occurs when the yield curve is uninverted. And markets typically rally up until that point. So maybe this ties in with a lot of what we've been saying about potentially this bear market in the same way that this bull market came to an end on that RSI divergence. Maybe has blown its load. Sorry to be so crude this morning, but we're in one of those kind of way too much coffee, not enough water kind of vibes. So we've looked at a number of things. We've always said, actually, and it's all on my, all my videos are still left up. All my tweets are up. We don't delete anything even when we get things wrong, and we get things wrong all the time. We have actually said that there's always been a possibility of retracing this FTX capitulation. And you've basically done that, and it's natural that you're going to have a break here, and we are looking at what comes next in more depth in my Patreon, but also, we've been doing a lot of that here, and we're going to continue to do it. So what we're going to do today really predominantly is look at the yield curve. It's not boring. Finance is only boring when you've got a teacher talking to you about it, just like history or anything else you learned in school. Finance is at the heart of everything, guys. It's the very tool that's used to enslave you. You don't think you're a slave, don't go to work tomorrow, and find out what happens. Certainly, that's the case in the Western world. And that's something we've always been a big advocate for, coming out and saying, regardless of the repercussions, is that, we are in a sort of financial bondage that I would love people to break free from. I've allowed myself a little bit more freedom through being a crypto and blockchain enthusiast and investor, and I'd love that opportunity for you guys, and that's what we're really trying to do on this channel. There's a number of interesting things that we're going to get into as well. We'll look at Bitcoin, of course. You've got Davos going on at the moment. Jamie Dimon, who is, of course, JP Morgan's CEO. I'll get through the news and then we're going to get into the yield curve. Says rates will rise above 5% because there is still a lot of underlying inflation. So that's what I think the euro dollars has still got us at over 5% for the US. Yeah, it's got us at 5.025%. So that would be overshoot if we get to this percentage in terms of the Fed, then markets I don't think would have priced that in. I think where markets are priced in is around about 4.6%. But we think rates are likely going to get to, and we actually looked at rates getting to where the 2-year government yields is, which is 4.8%, which is certainly interesting. So we think that potentially rates aren't going to get. We've said this before the CPI, before this sort of dovish tone was given by the Fed, that we actually think that rates are likely again, look at this divergence. People aren't fans of divergences, but I think they're actually a good way of looking at a macro trend and looking at its relative weakness or strength. I know there's Francis Hunt, the crypto sniper, does a great video on actually disproving many indicators and saying that they're subject to volatility, and volatility can mess them up. I like the RSI, but I do think he's got a very valid point on it. And actually, you know, so we think that rates aren't going to get probably past 5. They might, but that would still be in sort of the range of where this is predicting if this has topped. And we have speculated that it's topped. Remember, guys, we also looked at things like the USDT dominance. We'll get into it in just a second, guys. This is really important stuff. You know, we looked at all this previously. European Central Bank members say market is mispricing rate hikes. Expect more to come. Potentially there, of course. The thing is with these guys, certainly when they work for the bank, is a lot of actually what policy for the European, for central banks is telegraphing and talking. So they'll talk markets down. It's kind of like you're talking somebody off the ledge, you know? So you gotta be mindful of that. And I don't think actually that rates will get, I think they could go to 5, but I don't think they're going to get much past it. But let's focus on the kind of macro picture here, where the crypto space is. You know, we're going to move away from just looking at the crypto market on its own merit. And technically, we've speculated that actually this could be the bottom. We're not saying that it is, but we're saying it could be. And that we've adopted this non-bearish stance down here. It's not a recent one after the pump that we've switched, like most people or anybody that is now more bullish. Most people are still extremely bearish and very much have the bank on this being just a relief rally. Could be maybe you come down and put in a similar low or a marginally lower, but what we're saying is you know, we're actually happy to maybe allocate back into this market at this point after being out the market for basically all of last year. You know, everyone's a genius in a bull market. Look at what people do in a bear market and are they profitable? Something that's important. So let's talk about it. Well, this is the yield curve. So this is the main yield curve, which is the 10s and 2s for the US. It's government bond yield, so it's not the bonds, it's the yields. You have this inversion that basically preempts every single crash that follows. You know, the last one that this tracked was the crash of 89. Then you had the dot-com bust, 2008 financial crisis, something 19. And then you had the current, you can call this Russia-Ukraine yield curve if you want, I guess, or inflation yield. You can call it what you want. But essentially, this is still very, very inverted. And this is predicting a crash. But when that crash is going to come, is there any sort of insight into this? And this is what David was highlighting with the 3s and 10s. We can do it on and this is something we spoke about previously, the 10s and 2s. That actually, if you look at the recession and when it comes, recession overlaid, this is why I'm not a fan of bear steepener soon. So this is interesting because actually, the recession or the crash, and remember we've done this, guys, what we're going to go ahead and do is overlay the S&P as a kind of barometer for markets broadly. Yeah, I suppose we could do it like that. And we're going to go ahead and get rid of all the draws. Actually, this is when it's inverted. It wasn't until it went uninverted. So remember, you're at this 0 line, which is here. So this is your inversion, and this is okay, this is going to make a lot of sense. Let me put it onto the same scale rather than confusing everybody, guys. So we want the same scale. Okay. Remember, this is your 0 line here. So let's actually do this and get rid of all this to show you this, because this is super interesting. Not a lot of people are looking at this. Everyone's really still chanting a very bearish. And you've got to think, at the bottom of a market, would everyone believe it's the bottom of the market? Now, we're not 100% saying it is the bottom, but we're saying it could be. And take of that what you will. And if you know, one comment I got yesterday was, oh, well done, you're not really making a decisive call then. And you're kind of chopping a little bit. Obviously, we were max bears all last year. And we're now sort of probably leaning towards more of a bullish stance than a bearish stance. And people are saying, well, why are you changing? And you can't change. It's against the rules. You've clearly never invested or traded. If that's you have to constantly be assessing the situation and rejudging it as you move forwards. So this is, of course, inversion. We've looked at the events. Now, you have the inversion, and it wasn't actually until here. We'll actually just go and highlight it, guys, on every single account. Inversion. Crash. Look at where the yield curve is in respect to the inversion. So this is your crash. So here maybe you've got a bit of a pariah. But then again, you had the first inversion here and markets went up. So maybe you're in this kind of a territory where markets may just have a little bit to go up, and then you get something like this in terms of the S&P. Still a possibility. It's why we're not full-fledged bulls, because we still think that, look, you could look at something like that for the S&P, but you may be sat on the sidelines waiting for a crash that may take a lot longer to play out. And then of course you've got this inversion here, and you actually didn't have the, this is obviously the crash in 1989. You actually didn't have the, it was here when the actual crash took place. So it's not until point of inversion, or when the chart isn't inverted, that you actually get the crash take place. So there is the possibility that maybe you come up here, we see some sort of an inversion into a crash. That's a possibility. Something's coming down the road. This is what the yield curve's telling us. But markets typically actually at the point of inversion, when it's extremely inverted, tend to rally in most cases, which is very, very interesting and kind of defies a lot of the narrative that's out there. From a macroeconomic standpoint, we've basically said, look, the worst is behind us. Markets being forward-looking are now actually pricing in rate cuts. So markets will forward look at this. And this is extremely interesting. And we can dive a lot more into this if anybody wants sort of more in-depth version. This is from MacRalph, something that we looked at yesterday. The bond is pricing in La La Land, inflation back at 2.5% in 9 to 12 months. Fed's cutting rates are to 2.75. Potentially markets, just like maybe this European central banker is saying, are very much misrepresenting things. But at the same time, what the market's showing us actually is that it's now pricing in a lot less in terms of what it once was, and actually markets being forward looking can look at this. Now, we have said in terms of crypto, we are expecting a pullback. We were expecting a pullback this week. We've got it, by the way. All my videos are left up, guys. We said S&P's at key resistance before you had this candle. We've got it, and we said the dollar's at support. Dollar's a lot more weaker than I'd have expected, by the way, guys, so I'm not going to call that as a triumphant call just yet. I think it may play out, though. You've got this div here as well on the daily, which you've already highlighted. So it's going to be a very interesting week, but that's just some food for thought that you've got to take as investors moving forwards. That actually the crash doesn't come really until the point of uninversion. And at that point, most people have flipped only to get their pants pulled down. And this is actually, we've also scenario forecasted this as well, that you could be setting up for like a March 2020. Something like this, where you get this rally only for, there to be mass defaults on debt or something like that. Who knows? But that's all I've got for you in this video, guys. If you've enjoyed this content, a like is always really appreciated. So is a comment. And I look forward to seeing each and every one of you in the next YouTube video. Make sure you hit that subscribe button if you're not already. And I'll see you in the next one. Thanks a lot for watching, guys.